Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Overview and Tech Equity Technical Analysis. This video presents a direct, informational narration of the source document, so let's jump right in. We're kicking off this explainer with a strict, top-down technical and fundamental analysis of current U.S. stock market dynamics. Here's our roadmap for today. We've got 6 main stops, starting with the market overview and rumors. Then we'll look at semiconductor technicals, the software sector and Oracle, Palantir's valuation, Microsoft risk management, and we'll wrap things up with AMD and Tesla technicals. All right, part 1, market overview and rumors. Now, you might have noticed some recent market turbulence. Well, despite what some folks assumed about geopolitical energy concerns, like the recent events in the Middle East, this turbulence was actually driven almost entirely by internal weakness in the tech sector. Get this, the tech sector took a sharp intraday dive of 1.85%. But if you contrast that against the broader market breadth, the S&P 500 was remarkably resilient. We're talking 371 components up and only 131 down. That underlying data completely isolates the sell-off specifically to tech, while other weight-adjusted indices were actually climbing. So what exactly sparked all this tech anxiety? A major underlying catalyst was a Bloomberg report indicating that a U.S. developer has actually paused a massive 128-gigawatt AI data center project in Wyoming to accommodate client requests. The source notes that this move is raising quiet concerns in the broader market regarding capital expenditures, especially right on the heels of Broadcom giving some highly conservative forward guidance. Let's put this into a historical perspective. The source highlights a very specific number here, 19. Over the last 30 years, there have been exactly 19 times where the NASDAQ 100 dropped more than 4% intraday and broke the previous Friday's low. But here's the really interesting part. Statistical analysis shows that only about half of those instances actually closed below that level by the 5th trading day. So history tells us a drop like this isn't necessarily a guaranteed free fall. Moving right along to part 2, semiconductor sector technicals. This sector is currently sitting at a really fragile technical juncture. The timeline you see here outlines a pretty urgent situation for semiconductor indices like the SOXX and SMH. Based on the analysis, these indices absolutely have to break upward on Wednesday or Thursday, pushing past recent highs. Why the tight deadline? Well, there's an anticipated SpaceX liquidity event coming on Friday, and that's expected to draw speculative capital away from current market hotspots. Digging into the technical risks, the source points out that the uptrend lines for both SOXX and SMH are just barely hanging on. And because the slope of the current chart is so incredibly steep, maintaining that sustained climb is extremely difficult. Here's the kicker. If that uptrend support breaks, early buyers are highly likely to secure their gains. That could trigger a cascading wave of rapid profit-taking. Okay, part 3, the software sector and Oracle. The software sector has kind of been dragging its feet right alongside semiconductors. If we look at the IGV software index, upper resistance is firmly capped between 101 and 107, while lower support is sitting way down at 83.1. Right now, the index is just hovering in the middle of this wide sideways band, basically waiting around for a directional catalyst to make a move. And speaking of catalysts, check this out. A massive $26 implied volatility move is currently priced into Oracle's upcoming earnings. Now, the source flags that the post-earnings price action, meaning how the market reacts, not necessarily the earnings numbers themselves, is going to be a major catalyst. It could absolutely dictate the short-term direction for the entire software sector. So, let's map out Oracle's specific technical levels. We're looking at a support zone firmly between 187 and 203, with the resistance zone up at 230 to 239. On a fundamental level, confidence in Oracle's data center revenue has stabilized nicely. A big driver for this is the resolution of OpenAI's legal issues, plus their upcoming IPO, that secures funding for the client and gives Oracle some really solid underlying backing. Next up, part 4, Palantir valuation update. Palantir recently saw a pretty significant 37% pullback from its historical highs. So we're anchoring our updated valuation discussion around its 2027 forward price to earnings ratio, which is currently sitting at roughly 65 times forward estimates. Breaking down these valuation zones, the 120 to 130 range is considered slightly overvalued, but honestly, it's pretty reasonable when you factor in their rapid growth rate. The absolutely crucial takeaway here is that any drop under 97 is a big deal.
That represents a rare entrance into hysterical fair value territory based on those forward estimates, marking a highly significant long-term fundamental entry zone.
Moving into Part 5, Microsoft Risk Management. Let's shift gears to some actionable, evidence-based risk management strategies for navigating these short-term market fluctuations. The source outlines a very straightforward risk reduction plan for folks managing smaller spot positions, specifically under 100 shares. Basically, if the stock closes below 392, you reduce your position. Then you plan to repurchase anywhere below 375. And keep in mind, the document strongly emphasizes that the $400 level remains an undeniable long-term base for value investors. Now, what if you have a larger position? The source walks us through a precise options framework to protect against a potential drop, allowing you to avoid a taxable sale of your underlying shares. The strategy is a bear put spread. Step 1, buy the 390 put. Step 2, sell the 360 put. Step 3, target an August expiry to cover that historically volatile seasonal period. This exact setup protects against a $30 drop, making it a highly effective way to manage short-term downside risk. And our final section, Part 6, AMD and Tesla Technicals. We're concluding our individual equity breakdown with some strict technical updates pulled directly from the source's charting. For AMD, the technical map is cleanly defined. Overhead resistance is mapped out between 490 and 520. Your middle support is at 473 to 475, and lower support rests further down at 442 to 453. The source makes a point to note that holding that middle support level is absolutely crucial for the stock to build a solid, reliable base. Finally, let's look at the setup for Tesla. The analysis states plainly that Tesla has broken its support line. Right now, it requires a disciplined wait-and-see approach. So rather than trying to force an entry, the source advises waiting it out. You're looking for either a deeper pullback into that 315 to 365 range, or simply waiting until a completely new uptrend is technically confirmed. To wrap up this explainer, we want to leave you with a final question derived directly from today's macro analysis. Will speculative liquidity drain away from the tech sector ahead of Friday's major market events, or can those incredibly fragile semiconductor support levels actually hold their ground?